Hello everyone, welcome to the Value Investing channel. My name's Michael and today we're going to be talking about asset allocation. Asset allocation, or the way you divide your portfolio among various asset classes, is the first thing you should consider before you start investing because it's going to be the largest determinant of how your portfolio will act. To give you a better sense of the importance of asset allocation, I'm going to share with you a study at Vanguard where they explored the impact of both asset allocation and security selection on investors' portfolios. What they found was an impressive 88% of the variation of the portfolio returns were explained by asset allocation, while only 12% were explained by security selection. What this means is that setting your asset allocation is going to have a larger effect on your returns than whether you decide to use a passive index fund or select your own stock. If you start building your portfolio by finding the right mix of assets, you'll have more control for how risky your portfolio is. There are no good or bad allocations. You need to find the allocation that's right for you and your situation. When building your portfolio, there are going to be three main asset types you'll be choosing from: stocks, bonds, and cash. Stocks or equities are an opportunity for growth. When you buy a stock, you own a piece of the company that issues it. If you buy a company stock, you become a part owner and will generally make money if the company makes money and will lose money if it doesn't. Depending on how established the company is, you'll make most of your money through either increases in share price or through dividend payments. Bonds or fixed income are a way to get income and stability in your portfolio. Unlike stocks, they don't have an ownership right. They represent a loan from the buyer, you, to the issuer of that bond. Bonds can be issued by companies or governments and generally pay a stated interest rate. The market value of that bond will change over time as it becomes more or less attractive to potential buyers. Bonds that are high quality, more likely to be paid on time, generally offer a lower interest rate. Bonds of shorter duration, or shorter length until full repayment, also offer a lower interest rate than longer duration bonds. Cash is a path to safety and security. Cash investments can lower the overall risk of your portfolio and give you a place to hold on to money while you wait to invest it. Cash investments are a way to keep money safe from market risk. Setting your asset allocation means deciding how much of your portfolio is going to go into each of these slices. So how do you determine what's best for you? Most traditional investment firms will try to give you an idea by asking you some type of questionnaire. Here's a questionnaire that's provided by Vanguard. So let's actually jump into this questionnaire that Vanguard has for us. So when these things usually start off, some basic questions: how long are you going to have your money invested? When do you need it? But most of these will also have a few behavioral questions. That's one thing that I think can be a little misleading, but we'll see when we get to it. Question 4 is a behavioral question. So it's saying from September 2008 to November 2008, stocks lost more than 31%. If I owned a stock investment that lost about 31% in 3 months, I would what? So the options are sell all of the investment, sell a portion, hold on to the investment, or buy more of the investment. So if you're already sort of like thinking about this, you know that if you're wanting personally to see an allocation with more risky assets like stocks, the answer would be buy more of the investment. So when the investments go down, generally a better time to buy more value opportunities in the market. You know, they might say I would definitely buy more or hold on, but having experienced it, what they actually did was sell some or all of their investment. So if you haven't had like an experience of being in the markets when they're really bad, which for the most part, anyone who's starting investing now or in the past 8 years or so hasn't really seen anything like the financial crisis. It's hard to exactly say what you would do in that situation. I personally haven't seen a 31% loss and nothing like that and that quickly in 3 months. So, well, I'd like to say buy more of the investment. It's hard to exactly say what you would do in that situation. So just keep that in mind when answering these questions. Okay, so that's the survey. So let's see what the results say. If I had to guess, I don't think it's not going to be anything too ridiculous, but it'd probably be like 80 stocks, 20 bonds is what I'm guessing. Okay, so right around what I thought. So take these results with a grain of salt. They're a decent place to start thinking about asset allocation, but of course it doesn't have to end up being your final allocation. And just take note that a lot of these surveys, especially if you're younger, will suggest a higher allocation of stocks and a lower allocation of bonds than you may be personally comfortable with. Now there's another method of looking at asset allocation, and this is one that I personally use and recommend for new investors, and that comes from actually The Intelligent Investor by Benjamin Graham, and so we'll go a little bit more into detail on that. Graham's suggestion is surprisingly simple. He suggests an allocation of 50% stocks and 50% bonds for most investors. Now, that can change somewhat depending on whether you're a defensive investor or an enterprising investor. Defensive investors are looking for a conservative set of investments that requires minimal effort on their part. Enterprising investors, on the other hand, are willing to put in the extra time and effort it takes for dynamic portfolio management, research, and the selection of individual investments. While the defensive investor should stick close to a 50% stock, 50% bond split, the enterprising investor has more leeway to take valuations into account. Graham sets an equity or stock minimum of 25% and a maximum of 75% based on the attractiveness of the valuations. While I consider myself an enterprising investor, I currently find valuations too high to warrant a 75% allocation to stocks. So right now, my portfolio looks a lot more like a defensive investor. However, this will likely change in the future as the valuations of the markets change over time. Right now, my asset allocation is about 50% stocks, about 20% bonds, and about 30% cash. Currently, I'm not a big fan of the low interest rates on long-term bonds, so most of my bonds are very short durations, similar to cash equivalents. So think of it almost as 50% stocks and 50% short-term bonds or cash equivalents. Graham's suggested 50% split between stocks and bonds or cash is a good starting point for most new investors. If you're an enterprising investor willing to put in the effort and think valuations are attractive, you can increase the proportion of allocation that goes to stocks. However, just be psychologically prepared for the added risk that comes with that. Remember, to recover from a 50% loss, you need a 100% gain. I'll have more content in the future on this topic, but I hope this gives you at least a starting point to begin thinking about your asset allocations. I'm Michael J. This is the Value Investing Channel, and until next time, thanks for watching.